Welcome back, students, to our series for managerial accounting. This is my second lecture. Yesterday we stopped at slide number 17 for chapter number 8. This is what we started in chapter number 8. It was about performance evaluation. Then we looked at flexible budget. How can we prepare a flexible budget from given data, right? Flexible budget is easy to prepare using a static budget. Just review these slides again. What is a variance? We already looked at it yesterday. What is a variance? Whether a variance is favorable or unfavorable, right? In terms of cost as well, we have a favorable or unfavorable variances. Just review these slides again, and how we can calculate sales and variable cost volume variances. This is how we calculated sales volume variance. Then how can we interpret the volume variance? Okay, then we looked at calculating and interpreting the flexible budget variance. How we calculate a flexible budget variance from standard and what was actual. We prepared a budget here, flexible budget, and we compared it with the actual and looked at it whether it's a favorable or unfavorable. Then this is how we can calculate a sales price variance, and what are the human elements associated with flexible budget variance. And this is what we will start today, our second lecture of chapter number 8, which is about calculating and interpreting fixed cost variance. As we know that fixed costs normally they do not fluctuate with volume, but keep in mind, it's very important that this does not mean that actual cost will be same as the budgeted cost. Actual fixed costs might be different than the budgeted fixed costs. So as a result of this, we have two types of variances, which we call them fixed cost spending variance, and another one we call fixed cost volume variance. First one is spending variance, right? What is a spending variance? Is that the company normally pays more fixed cost than what was the budgeted. This is what we call it fixed cost spending variance. In our example in this book, if you look at exhibit number exhibit 8.3, I'll show you again here. Exhibit 8.3, exhibit 8.3, yes, this one on page number 357. It shows there that if you look at a fixed cost here in the bottom half, right, it is, if you look at a total amount, it is 291,600, and the actual fixed cost actually which was spent is this one, which is 295,000. So there is a difference between budgeted cost and actual cost. This is what we call it fixed cost spending variance, and this is what's shown on slide number 19 here. Clear? So this is a spending variance, and this 3,400, this amount is our variance, right? So our actual fixed costs are more than a budgeted fixed cost, so it is an unfavorable spending variance. Next, accountability. Now, who is responsible for fixed cost variance, right? Now that 3,400 the variance, who is responsible? Now Remember, this chapter is all about performance evaluation and finding out how to fix these errors. So in order to look at it, first we have to find out that what are the fixed costs which are controllable by some manager. Then we must disaggregate them. We just divide it, or we can you can say dig down into more pieces, right, and look at those things for individual analysis. For example, supervisor salary is a fixed cost, but suddenly there was an increase in a supervisor salary, and that supervisor falls under plant manager. So now management can ask this question to plant manager, why this supervisor salary has been increased from the budgeted amount. What was the reason, right? Or sometimes there are uncontrollable fixed costs. Now even it is those are uncontrollable, still they can be given to the management for their oversight. For example, rent has been increased, so they may not take any action immediately in a short term, but in long term they may consider how those costs can be controlled. So accountability is very important, and as I said before, that in variance it is very important to find out who is responsible and then how we can fix those problems. Now next we'll move to our fixed cost volume variance, which is very important. It needs some calculation. Now as we know that actual volume is not known until end of the period, means actual means how much we are going to sell, we don't know until end of a year. But in order to sell a product, we have to put its selling price, right? Now that selling price is based on how much we are going to sell. Now like in this case, this company has planned level of 18,000 units which they will produce and sell. So based on this 18,000, fixed cost was 291,600 divided by 18,000. So our fixed cost per unit is 16.80. This is the fixed cost. Similarly, we have variable costs like material, like labor. We have already seen them on the previous slides, or I can show you here as well again for your reference, that what I mean here. This one you can see here. This is material cost is variable, labor cost is variable, overhead is variable, this is variable. Now what is the profit on each product or on one product? Depends on the one item more here, which is a fixed cost per unit. So 80 minus all these costs, you will know what is your profit or the net the profit on each product, because that's how you set your selling price. The selling price depends on these elements, your cost, because at the end you want to make a profit. So I hope it's clear now what is the purpose of calculating a fixed cost per unit. If it's not clear, still you can send me a message, I'll explain. Okay, so here 16.20 is a fixed cost per unit. Now this 16.20 is our predetermined overhead rate, that we will allocate a fixed cost based on this rate. But when we have an actual volume, we find out that per unit cost, if you have 19,000 units, now your fixed cost per unit will change. It is 15.35. It has been changed. Or if we, I'll just show something, just a minute. Yes, now it's clear. Now if you look at the same information, the same 19,000, what is the fixed cost per unit? 15.35. What if it is 20,000 units? See, fixed cost per unit has been decreased. Let's say if we have 30,000 units, fixed cost per unit has been decreased. So if we produce more and more, fixed cost per unit will change. If we increase the number of unit, the fixed cost per unit will decrease. Let's say if I put this one to 10,000, it is now fixed cost has been increased. Or if I put this as 15,000, now fixed cost per unit has been increased. See, 18,000 unit, it was 16.2, but when we decrease, fixed cost will increase. Fixed cost per unit, remember, not total, per unit will increase if you decrease the number of units. Okay, so this is very important concept in this one, right? So this is the reason that it's very important for us to understand this concept. Now overhead rate is very important because based on this one we will assign the fixed cost. Now how much is the applied fixed cost, right? See here, based on this rate which we calculated, I just shown you in the previous slide. Yes, now and applied fixed cost, this is very important concept. After we calculated the rate, as I've shown you before, applied fixed cost. Now what is the per unit cost? This one multiplied by the actual volume. So this is what we call it, applied fixed cost based on actual volume. Very important. This one is applied fixed cost based on actual volume. But what was our budget? It was this one given previously, 291,600. So now the fixed cost volume variance is this minus this, which is 16,200, right? So now if the in this question here, fixed cost volume variance is 16,200. Now what is the interpretation of this 16,200, this variance? Now this 16,200, which is a fixed cost volume variance, right? Now what will happen to the fixed cost per unit if we increase the number of units, right? From 18,000 to 19,000, right? I'll go back here, I'll show you, right? If it is 6 from 18, let's say if I increase the number of unit 19,000, see, fixed cost per unit is decreased, right? You can see the behavior of fixed cost. If you increase a volume, fixed cost per unit decreases. Okay, why? Because when planned or the budgeted unit was 18,000 and the actual are 19,000s, right? And these units are higher than the budgeted or expected one. So as a result, fixed cost has been decreased. Now this volume variance is, we call it, it's a favorable volume. Remember, we sell more. So it is a favorable volume variance, right? Okay. Now similarly, you may have a unfavorable fixed cost volume variance when your actual volume is less than the planned one. Means if this is, let's say, 16,000, right? So now you can see your fixed cost per unit decrease. Now in this case, it is a unfavorable fixed cost volume variance in this scenario. In this scenario, when you increase, again say, now it is a favorable variance because your number of unit has been increased from your budgeted amount. This is what you planned. So this one is increased now. So clear? Okay. Now this, I'll go back, sorry, yes. Now this is the summary of those two fixed cost overhead variances which we just discussed. Just look at this summary of same thing what we have discussed, why it is favorable or unfavorable. And this one, sorry, this one should have been favorable based on 19,000. So this is a correct statement. So it is a fixed cost volume variance is favorable. Okay. Now next slide. Who is responsible for this fixed cost volume variance? Remember, it is part of performance evaluation that the amount of variance is, first of all, it's easy to calculate the amount. Now who is responsible is very difficult. In a real life scenario, no one is going to accept the responsibility that this variance is increased by them. So normally upper level marketing managers are accountable for fixed cost volume variance. Why? Because this sold more than what was the budget. Now of course logically it is good, but how they achieved it? Maybe they reduce a price, or there are some other certain situations, right? So basically fixed cost volume variance normally is a measure of facility utilization, right? If our fixed cost volume variance is unfavorable, it means that facilities were not utilized properly. This is very important, right? A favorable fixed cost variance suggests that company utilize or facilities more than the planned level of more than the planned volume of activity. So fixed cost volume variance normally indicates over or under utilization of facilities. It's not about spending, that whether we used our resources more appropriately because you had a capacity to produce more, but you did not produce. Like in this case, we produced only 18,000 units. So as I discussed before as well, that Chinese products, why they are cheap? Because they produce the quantities in large number. Their fixed cost per unit decreases. As a result, their products are cheap. So that's why you can find a very cheap Chinese products, because they spread fixed costs over a large number of units. So that's how they decrease their fixed costs per unit. So this is end of my lecture. If you have any question, you can send me an email, or any issue. Again, try to solve a questions, practice and practice. Wish you all the best and hope this lecture will be clear to you. Best of luck.